bond markets are to be segmented. So you have the short part of the bond market and the longer end of the curve. So if you think about the bond yield curve, you have anything between 2 years and 5 years. That is the shorter end of the curve, and especially the 10-year plus, that is the longer end of the curve. Those are driven by different factors. Even when you think about growth and inflation, you can think about them in a separate way. And let's start from the front end, 2 to 5 year bonds. So 2 to 5 year bonds will mostly reflect what the central bank will be doing over the next 2 to 5 years. All central banks around the world, Alex, have pretty much a dual mandate, either explicit or implicit. The Fed has an explicit dual mandate. They say literally they are targeting the labor market, so good, solid labor market, and inflation around 2%. The central bank only has an explicit inflation target, but an implicit growth target. In other words, they always try to balance growth and inflation. They want predictable inflation around 2% and the economy to grow organically well. That means that the front end of the curve will be reflecting again what the central bank does for the next 2 to 5 years, and what they do will depend on growth and inflation. So if inflation is very high right now, the central banks and above their target, the central banks will feel compelled to raise interest rates to bring back inflation to their target, because being credible as a central bank is the most important thing. They want to be credible in their ability to bring inflation down to 2%. So if inflation is 1 or 3, that's okay. But as soon as you get way above these bands, both on a deflation or excessive inflation, you will see them react very aggressively. That's what we have seen in 2022. When they do that, the front end of the bond market will have to react as well, because 2 to 5 year bonds, they basically reflect the central bank stance for the next 2 to 5 years. And that's what we have seen. Front-end bond yields have gone up very rapidly. But we have also seen that the curves have inverted. So the yield curve has become inverted. In other words, the interest rates have gone up so rapidly at the 2 and the 5 year points, but not so rapidly at the 10 or the 30 year point, to the point where the curve became pretty much inverted. And it has been inverted now for 17 months and counting in the United States. What does that mean? The 10-year to the 30-year part of the bond market thinks much more in medium term than only cares about what the central bank does. And what really influences long end bond yields is expectations about future growth for the next 10 years, the next 30 years, and expectations about future inflation for the next 10 years and 30 years. So the bond market is generally relatively smart about it, and they think, well, now the European Central Bank has hiked interest rates to 4%. Wow, that is pretty much unprecedented. We have last seen something like that 25 years ago. So is the economy able to handle 4% interest rates? Well, it's going to be hard, all these leveraged corporates, all these leveraged households. Can the housing market work so good with mortgage rates at 5%? Probably not as good. And so what the market does is they say, yes, for the first 2 or 5 years, you will keep interest rates very elevated, but you will make a damage to future growth and future inflation. In other words, we are going to lower our expectations for future growth and future inflation because of the damage that you will be doing to the economy by raising interest rates for the next 1 or 2 years. And so it ends up being that long end interest rates are more of a reflection of what happens after year 2, year 3, year 4, and year 5. And as people become more pessimistic on growth and inflation, long end interest rates have a harder time going up as fast as the front end, and so the curve inverts. That is also a signal from the bond market, indeed, that they expect damage to be done to growth and inflation down the road. This is one of the reasons why a yield curve tends to be a good indicator of an upcoming recession or not. When it's inverted, people tend to say, okay, I see that the bond market is telling me that this is going to generate damage down the road. And inversions tend to predict recessions, but there are some steps in the meantime. The typical mistake people do is the yield curve inverts and they say a recession is coming now. But the reality is a bit different. It takes some time between the initial yield curve inversion to feed into enough economic weakness to ultimately lead us into a recession, and this time lag is variable. It's anywhere between 10 months and 27 months. So there can be a year and a half of time lag, of variability in this time lag, and more than 2 years actually from the initial curve inversion to the recession itself. So these are the mechanics. The yield curve inverts. The Federal Reserve or the ECB are hiking rates aggressively, and the bond market says, well done, guys, but I'm going to say that growth and inflation are going to be slower. There is then a period, the so-called macro lag, anywhere between 10 and 27 months. And in this period, what will happen is that the private sector will start feeling the heat. The variability depends on how much refinancing has to really be done soon. What is the portion of your liabilities, of your borrowing as a private sector, which is variable? If you have a lot of variable rate mortgages, a lot of variable rate loans, the pain is immediate. The central bank is raising rates and you feel it immediately in your bills at the end of the month. So you will be spending less. And so the recession comes earlier. You are closer to the 10 months in the macro lags rather than the 27 months of the macro lags. If you have a lot of refinancing to be done, that's another indicator that you will be closer to the 10 part, because a lot of debt is coming due, which means you have to refinance this debt. And as you do, as we explained before, you'll face a higher bill, you will be spending less, you will be falling into a recession. But it can also be 27 months, because as per the United States, they don't have a lot of variable rate mortgages. They don't have a lot of variable rate loans. That means the pain isn't felt immediately. It takes a while until you reset these mortgages. Also, in 2019 and 2020 and 2021, mortgages were locked in for 30 years. Corporate borrowing was locked in for 10 years plus, which means the refinancing are coming, but very slowly. So that means it takes longer for the yield curve inversion to feed into economic weakness, which is aligned into a recession, which means you might be closer to the 27 months than you are to the 10 months. So remember, tightening, the yield curve inverts, time lags, which are variable depending on the structure of the economy and the structure of private debt, and then finally a recession. This is the sequence that moves the yield curve inversion to feed into economic weakness, which is consistent with the recession.